Here's the question. If you suddenly had $10,000, would you pay off debt or invest it? Because while most people are racing to be debt-free, the wealthy, they're doing something different. They don't fear debt. They use it strategically to build more wealth. Today, let's discover how they do it and how you can as well. Most of us are taught that debt is very dangerous and you should never owe anyone anything at all. But the wealthy, they often see debt as leverage, a tool that multiplies opportunity. They separate it like this. Check this out. Bad debt, such as credit cards, car loans, anything that loses value or that's a depreciating asset. Good debt, anything that earns you money, like real estate, running a business, or a margin account tied to appreciating assets. The average person says, I can't afford it. The wealthy ask, how can this debt work for me? That's very different. Now let's get into why the rich often don't pay off debt, and specifically certain types of debt. For example, if a wealthy person has a 3% mortgage, they usually don't pay it off early. Why is that? Because typically they know that they can earn more, maybe 7 to 10%, often 12%, investing in other vehicles and elsewhere. That's the concept of opportunity cost. For example, that 3% mortgage, you pay that off and you're guaranteed a 3% return. But investing that same amount could double or triple over time. The reality is that even a high yield savings account that was 4.25% is more than that 3%. And that's a minimum. That's not even talking about the S&P and the market, which typically returns 10% over the life of the market. And what the wealthy realize is that it's not about avoiding debt, it's about optimizing it. Let's take a look at this example here. So both people here have $200,000. Person A pays off their mortgage at 3%. Person B invests that same $200,000 at 8%. After 10 years, person A saves about $60,000 in interest, which is a lot of money, $60,000. However, person B has the ability to earn $116,000. Same money, but a very different result. That's leverage using low-cost debt to fuel higher returns. Now, you want to be careful because there is a catch with this. As with everything in life, the leverage can cut both ways. If your investments drop or your cash flow slows, you still owe the bank or the finance company. That's why wealthy people use controlled leverage. They borrow against appreciating assets, real estate, businesses, portfolios, not against lifestyle or consumption. They keep safety nets, cash reserves, diversification, so they never risk everything on borrowed money. So let's get into these rules that will help you. Rule number 1, kill that high interest debt first. That 20% APR on that credit card, get rid of that thing. Get that out of your life as quickly as you can. That's definitely something that can hold you back. The negative return on that is not good. Number 2, keep low interest debt if you can and invest the difference. That's positive leverage. Number 3, build an emergency fund. The wealthy, what they do is they protect the downside before chasing the upside. So when you have this emergency fund, as you know, things will happen, the flat tire, the roof, which at my house, we had the roof and the plumbing, which was really tough. That was a big one. That was a big one. Those were big. So I know all about the emergency fund. It's very important. Number 4, use debt for assets, not liabilities. A rental property, that could probably be a good idea. A new car on credit or a car lease, not a good idea. That's pretty straightforward. And I have a video on that too. The car leasing is really not good for most people. And at the end of the day, in the final analysis, it's not really debt versus investing. It's how you do both. Bad debt can really trap you, and good debt could amplify you if done properly. One way to look at this is that you need to stop seeing debt as evil or the devil over here and start seeing it as a tool that when used wisely and efficiently can multiply your financial freedom. And the last thing I'll say here is that the market, the returns on the market in the last 15, 20, 25 years are unprecedented. Does anybody remember 2008 if you were around, or if you've watched a video on it or researched it or learned about it in school? The Dow Jones was down to 6,500. It's now at 48,000. It's almost at 50,000. That is a tremendous return in approximately 17 years. So if you'd spent the last 17 years paying off your house, which is fine, or your apartment building or whatever you bought, that's great. However, you need to be doing both at the same time because the returns in the last 17 years on the market, you might have lost out on hundreds of thousands of dollars if you decided, I'm going to pay off this debt first before I invest. So you want to try to do a balance where you're investing and paying off debt at the same time because you cannot miss out on the returns in the market. It's really tough to get those returns. So if you liked the video, don't forget to like and subscribe. I really appreciate it. This has been Damon D. Stack smart and stack off.